How is royalty income taxed? Have you ever wondered how royalty income is taxed, especially when planning for retirement? It's a topic that many retirees might face, especially those who have created works or owned assets that generate ongoing payments. Let's break it down in simple terms. Royalty income comes from payments made to you for the use of your creative works, like books, music, or patents. It can also come from natural resources or franchises. When you receive these payments, they are usually reported to you on Internal Revenue Service Form 1099 Miscellaneous Income in Box 2. For tax purposes, royalty income is treated as ordinary income. This means it is subject to federal income tax just like your salary. If you earn these royalties from a business you actively ran, you might also face self-employment tax. This is important for retirees to know because even if you are no longer working, if the royalties relate to your previous business, you could owe this tax. The Internal Revenue Service looks at whether you were actively involved in the business when the work was created to make this determination. If your royalty income is not tied to an active business, it is often classified as investment income. In this case, you report it on Schedule E of Form 1040. Self-employment tax typically does not apply here, but be aware that it might be subject to the net investment income tax, which adds an extra 3.8% tax for higher earners. State taxes also come into play, and these can vary widely. For example, in states like California, your royalty income will be taxed at your applicable state tax rate. You can also deduct certain business-related expenses that helped you generate this income, such as legal fees or licensing costs. This can help lower your taxable income. If you pass away and your heirs receive royalty income, they report it as ordinary income too. The intellectual property may also get a stepped-up basis for estate tax purposes, which can be beneficial. For retirees, understanding the tax implications of royalty income is key. It can provide a steady income stream during retirement, but it can also increase your taxable income and tax liability. This includes self-employment taxes and potential investment income taxes. Careful planning can help manage these impacts, like keeping track of deductible expenses related to your royalties or timing when you recognize this income. In summary, royalty income is taxable as ordinary income on both federal and state tax returns. If it is connected to an active trade or business, self-employment tax applies, even in retirement. Royalties treated as investment income are subject to regular income tax and, possibly, the net investment income tax. Business expenses related to generating royalties can be deducted to lower your taxable income. Heirs receiving royalty income after death report it as ordinary income with similar tax treatment. Retirees should consider these tax implications in their overall retirement income and tax planning strategies.